Walczak is Chief Investment Strategist at CFC Seymour Limited, and he joins us now from Hong Kong. Derek, great to see you this morning. I guess the big question here really is, does this signal the end of the bear market that we've been seeing, in China in recent months?
I'm pretty sure that it does, that in fact the lows of 2 days ago, when intraday the index moved below 3,000, will in the future be looked back upon as the bottom and a time when the next leg of a rally has begun. And the main reason here is that the government in China still has so much potential influence on what's happening with the stock index, and clearly they sent a message that they do not want further declines, that they would like the market to rebound, and this is definitely cheering investors.
Right, so Derek, really it's that signal from Beijing, that it's going to do something, and do you think it's going to continue to do something to keep the market afloat, particularly ahead of the Beijing Olympics?
I think it's an important consideration for Chinese policymakers not to have Olympics at a time of stock markets declining and the population possibly complaining about that. So definitely the government will want the recovery in the market to last through the summer. I don't think that they will announce any new measures anytime soon, because today's reaction is very optimistic already.
Right. And as far as the impact is concerned, this is going to be a long-term impact. Do you think it's going to last long enough to the end of the year, perhaps?
Usually the short-term impact of changes in the stamp duty is the most dramatic. I think that what happened today will help us in the medium term, but other considerations will take the Chinese indices higher as the year progresses. For instance, the decline in inflation and the pretty imminent end of the monetary tightening measures. And our forecast is for the index for Shanghai Composite to end the year at 4,500.
4,500. Derek, you brought up inflation, you brought up growth. Some reports have suggested that this move is actually a step backwards in terms of, well, it's a short-term gain that we're seeing in the markets right now, but in fact compromises Beijing's position in terms of what it can do for inflation, what it can do in terms of its broader economic policies. Do you agree?
I don't think so. I think that Beijing has many other measures to manage macroeconomic growth, both administrative and in terms of monetary and fiscal policy. What they have done right now is simply aimed at restoring confidence among stock market investors. Beijing wants GDP growth to be driven by consumption to a larger degree, and if investors have lost too much, then maybe they will not consume as much as the government would want if they lost too much in the stock market. So this will avert that risk.
All right, let me ask you a little bit about valuations now. The Shanghai Composite, way off its highs hit October, still commands a bit of a premium compared to the H shares. How are they looking to you? Do they look attractive at all right now?
In terms of valuations, the Shanghai market is definitely the most expensive in Asia right now, trading at forward-looking PE ratio of 20 compared to 14.5 for Asia Pacific. So it is not cheap. But remember that the same argument that held last year is still valid, that the market is benefited by the fact that local investors do not have the freedom to invest abroad. So there is sort of captive demand here, and this, in my mind, makes the market attractive at these levels.
Right. Let me ask you, the other factor which has been raised as well by some analysts is the appreciation of the yen and China's capital controls. They're saying that these factors, given the fact that the yen will continue to appreciate, justifies this premium as well. Can I get your thoughts on this?
You mean the yuan, right?
That's right.
From the perspective of foreign investors, obviously the outlook for continued appreciation of the Chinese currency makes investments in the Shanghai market additionally attractive, because you will not only gain from the stock index rally, but also from the currency gains. From the local investors' perspective, I don't really buy the argument, because China is big on exports, and margins of exporters will suffer as the yuan appreciates. So I don't think that this is a major factor here.
All right, Derek, just cross over to what's happening in Hong Kong as well. We're seeing a bit of a pickup for the Hang Seng Index. What sort of an effect is this going to have? Is this going to have a lasting effect, particularly, for the situation in Hong Kong?
I believe it will, because half of the shares here in Hong Kong are mainland companies, and in terms of market capitalization. And as the A shares rally, there must be some impact on valuations of H shares, and the Hang Seng Index will benefit from that. Because we believe that the Shanghai market will go sharply up over the course of the year, we are also bulling on the Hang Seng, and we expect it to end the year at 27,500.
And Derek, any sector which looks particularly attractive right now, given the fact that, valuations have come down a little bit?
I think that the banking sector might look quite attractive, given the fact that we do not expect much further monetary policy tightening. And it seems also that growth slowdown will not be that dramatic. In fact, the next quarter may be even better than the first quarter. So a lot of the bad news is already priced in, and the banking sector should benefit.
Okay, Derek, don't go away. We'll come back and talk to you some more, in particular about the banking sector in China, as well as the region. Derek Kowalczyk, Chief Investment Strategist at CFC Seymour Limited, will stay with us.